Welcome to Illuminati Silver. We tell you the truth about silver. Today is Monday the 21st of June 2021. And earlier today we produced our morning update entitled Monday Morning Gold and Silver Update, Gold and Silver Higher This Morning. We place a link to this, in case you haven't had an opportunity to listen to it, below. We also list below some important videos we've produced during the last few days covering the recent gold and silver price crash. Now in today's video, we're looking at a great article published by thebalance.com entitled Should You Buy Gold?, which covers how you can buy it, in what form, and what you should consider when doing so. We will look at the article and comment throughout its reading. It'll prove particularly useful to those new to investing in precious metals. So without further ado, let's take a look. Well, let's take a look at this site, thebalance.com, updated just a few days ago, June the 16th, 2021. Should you buy gold? The precious metal may be a good investment. Here's why. Now, we'll run through the article, but then give our comments on it as we go through it. What to know about investing in gold, and this is particularly useful for new people new to buying gold and silver. Always buy physical gold from a reputable dealer, because of course you don't wish to be sold a dud, and even reputable dealers occasionally get it wrong, but generally will refund you when that happens. Doesn't happen very often, in fairness, not if they're reputable. Gold in the form of coins or bullion must be stored in a secure environment, like a brokerage firm or a bank, or in a safe, or hidden in your garden, dug somewhere. Why? Because, of course, it's prone to being robbed. Like any investment, gold is subject to supply and demand pressures that cause the price to fluctuate. It's also the result of speculation, which is supply and demand, arguably, particularly on the paper markets. You may not necessarily get the market price when you need to sell. Well, certainly not the physical, that's for sure. Very often dealers will charge you premiums when you want to buy and try and discount it when you want to sell, except when there's huge demand. And then sometimes, doesn't happen often, but sometimes you'll get above spot price simply because these dealers already know they have someone else to sell to straight away. If investing in gold mining companies, the stock price may reflect the company's overall value rather than the price of gold. Well, that is quite obvious. If the management's rubbish, the gold price could be going up. But of course, the price of the company's stock could be falling. Or if the company is diversified into other avenues, or the directors are just taking too much money out in the form of drawings or salaries. It may not be wise to have more than 10% of your assets in gold. Now, we know gold bulls, stackers, collectors may argue with this, but this is approaching it from an investment portfolio point of view. Because at the end of the day, there's a very strong argument in favor of diversification of assets. Generally, when you diversify, you don't make the huge gains that some people make by focusing on one particular asset class that then enters into bubble territory. But equally, they don't lose it all either, or very rarely, which such people occasionally do. Just ask those who've invested all of their wealth into the equity markets just before major stock market crashes, those in property just prior to 2008, and so on and so forth. Gold has been a valuable commodity for centuries. Throughout recorded and unrecorded history, gold has been used as a currency and a symbol of wealth and power. Gold has been found in grave sites, buried alongside remains dating back as far as 4,500 BCE. And yes, that is the case, and particularly pharaohs like to have their bodies buried with huge amounts of gold. This long-standing value demonstrates the stability of gold and its attractiveness over time. Gold is considered by investors to be one of the safest investments, recovering its value quickly through economic downturns. Its price often tracks in opposition to stock market or economic swings. And we'll cover that a little bit further on. But it is generally true that as a hedge against inflation or currency devaluation, gold over time has proven its worth. When investor confidence is shattered, gold prices often climb as nervous investors look for a safe place to put cash pulled out of the market. Gold is also a haven in times of inflation because it retains its value much better than currency-backed assets, which may climb in price but drop in value. If buying gold as an investment sounds like a good idea, read on to learn more. Now, as we know, this channel isn't about pushing any particular form of investment and certainly not giving investment advice. But it is interesting to look at those who are advocating gold as an investment as to what they say. Investing in gold is not like buying stocks or bonds. You can take physical possession of gold by buying either gold coins or gold bullion. Bullion is gold in bar form with a stamp on it. The stamp contains the purity level and the amount of gold contained in the bar. The value of the bullion or coin comes from its precious metals content and not its rarity and condition. And it can change throughout the day. Now, we'll take one exception to that because there are some coins, gold coins, that do have a rarity value and a condition appreciation. But it's basically telling you that in the main, that is an exception. You can buy bullion or coins from some banks, dealers, brokerage firms, and the US Mint, which has been producing gold coins and bullion for investment since 1986. And of course, regardless of whichever country you're in, you can purchase them from your relative mints as well. You can also buy stock in gold mining companies, gold futures contracts, gold-focused exchange-traded funds, and other regular financial instruments. If investors purchase a gold-backed ETF, they're purchasing shares of a trust's ownership in gold, but have no claim to the physical gold itself. And that's very important for those, what I call purists, who believe they must hold the physical to own it. Important. Investing in gold with the idea it never loses value is the wrong approach. Like any investments or financial asset, gold is subject to supply and demand pressures that cause the price to fluctuate. And if we take just a quick look at that very aspect, if we look at gold and we'll look at it over, let's say, a 50-year time period, you can see that gold certainly has fluctuated. If we go back to 1973, you could buy it for $40. It rose to $169 by the next year, fell back slightly, then peaked for its time in 1980 at $763 or thereabouts, then fell, and then for a number of years did not get back to that 763 level until approximately 2007. That's a big time gap. And then rose as high as back in 2011 to $1,800 or over $1,800. Then it took another almost 10 years, not quite, 9 years to get back to that price. So there have been periods, lull periods for the gold price and up and down periods. But the trend is always up, which is why we say it's generally a good inflation proof, providing you keep it long enough. Okay, let's go back to the article. Current and historical prices of gold. Investors should start by looking at the spot price of gold, which is what it can be bought and sold for at that moment. The spot price of gold is quoted per 1 gold ounce, gram, or kilo. For example, by the end of the day on Monday, the 7th of June, the spot price of gold was $1,903 an ounce, $61.18 a gram, and $61,181 a kilo. If you look at historical gold prices, you'll find that the price of gold shot up dramatically in the 2000s, and in 2008 the price of gold varied from around $720 an ounce to over $1,000 an ounce. As the economy sank further into the recession, gold prices soared to around $1,895, just short of that $1,900 in 2011, due to investor sentiment and demand. By April 2020, gold prices declined slightly from where they were almost a decade earlier, but continued to perform well in the midst of an economic downturn. Something similar happened in the late 70s, as we showed you in that chart. After the price increase in the 70s, gold spent the next 20 years declining in value before going back up around 2000, 30 years. During the pandemic crisis, demand for gold surged and the price of gold increased. Investors couldn't be certain at that time whether the increase would continue or not, because it is equally possible that the trend could continue, or the price would once again languish for a considerable length of time. While languishing, any gold investment would not produce any interest or dividends, which is why the likes of Warren Buffett and other major investors over the years have not advocated gold, because they're looking for assets that grow in value and provide some form of dividend yield or income, which gold does not. You're looking entirely at its capital appreciation. Now, what form of gold is the right investment for you? Well, gold comes in many forms, so one may be better suited for your investment strategy than another. You could purchase physical gold coins or bullion, but they must be stored in a secure environment. Now, this may involve paying a broker, a bank, or another firm a fee, such as Bullion Vault will hold your stocks for you offshore. You're never 100% sure that those stocks exist, except that they have independent assessors who are actually checking on those stocks. And providing the firm is regulated, you're reasonably protected. And Bullion Vault, for example, is regulated. Note, one of the benefits of investing in physical gold is that if you need to cash it in quickly, you can. However, gold coins and bullion are often sold at a premium and bought at a discount, so you may not get the market price when you do need to sell. As mentioned earlier, that is, for example, you're paying premiums, particularly at the moment, because the physical premiums are high, because allegedly stock is short, which it is in some cases. But then when you sell, the brokers only really want to give you marginally below spot. Investing in gold securities is similar to investing in any other security, except prices may move with the stock market. For example, if you're investing in gold mining companies, the price of the stock may reflect the company's financial health and market position more than the price of gold. This can create a false sense of security if you're using it as a hedge against risk. When should you buy gold? Many proponents of gold suggest it's a good hedge against rising prices. The facts do not support this statement, though. Gold is often a better hedge against a financial crisis rather than a hedge against inflation. In times of crisis, gold prices tend to rise. But that is not necessarily the case during periods of high inflation. If there's a financial crisis or recession on the horizon, it may be wise to buy gold. However, if the economy is in a period of high inflation, it may be wise to pass. Now, let's explain that for a moment, because they've actually left this bit out in the article. The reason that gold hasn't sort of excelled in every case of high inflation is simply because central banks have adopted high interest rate policies to combat that inflation. So that has made other forms of investments, like government bonds, giving you very high yields, providing a higher level of attraction. So unless you're in a third world economy, where perhaps even the government could fail and therefore there is no confidence in those government bonds, with those exceptions, this is why investors are then attracted to treasuries and government bonds and other forms of, shall we say, paper contracts provided by the government. So interest rates go up, people feel I can get 5%, 10%, 15%, 20% on my money guaranteed, and it's underwritten by central government. So that's why when you look at those charts, you don't always see gold rising again at the same time that inflation is occurring. The key element is what is the net rate. In other words, gold is attractive when the level of inflation is higher than the interest rate that you will get on your investment. And that is the time you'll see very often gold then rising during inflationary times. But the article is absolutely right when it says it's normally in periods where a crisis is either occurring or on the horizon that gold performs best. When investing for retirement, you need an investment that either generates current income or is reasonably expected to appreciate in value so you can sell it in the future and use it for consumption purposes. Gold is not an investment that you can rely on for either of these purposes. Also keep in mind that if you have gold in a retirement account, like an IRA, there may be penalties for early withdrawal if you decide to sell that gold and cash out. So what's their key takeaway from this? Well, investing in gold, whether the physical metal or gold-related securities, is a complicated decision and not one to enter lightly. If you do decide to purchase physical gold, make certain you're buying from a reputable dealer. If you're purchasing gold for your retirement account, you must use a broker to buy and a custodian to hold your gold. As a general rule of thumb, financial experts often suggest that you not have more than a small percentage of your assets in gold. Well, frankly, up until recently, most financial experts wouldn't even recommend that you hold any assets in gold. And we've expressed that in other videos, part of the reason being that most of them are not remunerated for doing so and push you into all sorts of funds where the commission rates are very high. Now, that doesn't apply to financial advisors who are paid a fee rather than earn commission on the investments that they recommend. It is sad that we live in a world where perhaps total independence and objectivity does not apply. But we have to bear that in mind, and so if you use a financial advisor and that individual does not recommend some form of precious metal investment, ask yourself the question, how is that advisor remunerated? And also, how is he trained? Because in some cases, although to pass relevant examinations, and we know this because we've passed both banking and wealth management examinations, there should be part of that training program an element covering precious metals, albeit, quite frankly, it's a relatively small part. This is believed to be good advice because it acts as an insurance policy. If you lose all other stocks in a crash, your gold should follow historical trends and go up in value, keeping you from losing everything. But remember, that's not guaranteed, so proceed with caution when buying this precious metal. That's the end of this article. We hope you found this useful. It certainly is a very simplistic description of should you buy gold or how you can purchase gold. We think there are some underlying principles here that you should take into account. And as mentioned earlier, this is primarily for new people considering entering into the world of precious metal investing. The same applies to silver, except that silver is marginally different in that its inflation proofing is not quite as good, ironically, as gold, but its capital appreciation opportunity as a percentage is potentially greater. Thank you so much for listening. If you like what you've seen, please give us a thumbs up. By all means, if you haven't done so, subscribe and press the bell sign so you're notified of our videos as and when they're published, and you'll see that earlier this morning we did a Monday morning roundup of markets, and what we can say is those who believe that cryptocurrencies are the equivalent to gold and silver may come and find that they're in for a shock, because at this moment the crypto market is going into meltdown. Whether that continues all week, we'll wait and see. Thank you for listening. Disclaimer. Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.